The big money crash. The story of the 2008 financial crisis. Once upon a time, not too long ago, there was a world where everything seemed perfect. People were buying houses, banks were lending money, and everyone thought life would just keep getting better. But no one knew that a big money storm was coming, one that would shake the whole world. This is the story of the 2008 financial crisis. In the early 2000s, banks were very excited to give out loans. A loan is money that you borrow and promise to pay back later. People wanted to buy houses, and banks were more than happy to help. The banks thought, if people don't pay, we can just take the house and sell it again. Since house prices were rising, banks believed they could never lose. Soon, the banks started giving loans to almost anyone, even people who didn't have good jobs or enough savings. These were called subprime loans. The word subprime means risky. But banks didn't worry about that. They thought house prices would always go up, so everything would be fine. Because getting a loan was so easy, everyone wanted to buy a house. Some people even bought 2 or 3 houses, thinking they could sell them later for a higher price. House prices began to rise very fast, almost like balloons floating into the sky. People felt rich, and everyone was happy. This was called the housing bubble, a time when house prices became much higher than they should have been. But bubbles don't last forever. One day, the prices stopped going up. Some houses didn't sell, and soon, they started losing value. The bubble began to burst. Suddenly, people realized their houses were worth less than the money they still owed to the bank. Many families couldn't pay their loans anymore. They had no choice but to give up their homes. As more and more people stopped paying their loans, banks started losing a lot of money. The houses they got back were no longer worth much, and no one wanted to buy them. But the problem was even bigger than that. The banks had been doing something very tricky with those loans. They took thousands of risky home loans and packed them together into boxes called mortgage bundles. Then they sold those boxes to other banks and investors all around the world. Everyone thought those boxes were full of safe and valuable loans, but when people stopped paying, those boxes were full of junk instead. This caused a huge problem. The banks that bought those mortgage bundles lost lots of money. They didn't know which banks still had bad loans, so they stopped trusting each other. They stopped lending money, not just to people, but even to other banks and good businesses. The money flow that helped the world run smoothly suddenly stopped, like a river drying up. When businesses couldn't borrow money, they couldn't grow or even pay their workers. Some companies had to close. Many people lost their jobs. The economy started to slow down everywhere. It wasn't just one country. The crisis spread around the world. Big banks that were once strong and proud began to fall. One famous bank, called Lehman Brothers, became so weak that it couldn't survive. When it closed, people everywhere panicked. The stock market crashed. People saw their savings and investments lose value overnight. The world had entered what we now call the 2008 financial crisis. Governments and central banks had to step in to stop things from getting worse. They gave emergency money, called bailouts, to save the biggest banks from falling. They lowered interest rates to make borrowing cheaper and encouraged people to spend and invest again. Slowly, after a few tough years, the world began to recover, but many families and workers were deeply affected, and it took a long time for things to return to normal. The 2008 financial crisis taught everyone some important lessons. First, it showed that lending too much money without checking if people can repay it is dangerous. Second, it proved that when something sounds too good to be true, like house prices always going up, it probably is. And finally, it reminded the world that trust is what keeps our financial system alive. When trust disappears, everything can fall apart. Today, banks and governments have more rules to stop something like that from happening again. They check loans more carefully and keep an eye on risky behavior. But the story of 2008 will always remind us how quickly things can change when people get greedy or careless with money. And that's the story of the 2008 financial crisis. How too many easy loans, risky bets, and broken trust made the world's money system crash like falling dominoes. But it also showed that people can learn, rebuild, and make smarter choices for the future.